I'm Ed Gilmer. I handle capital markets for passiveinvesting.com. And today we're going to talk about debt terms in the current market. I live in Murrells Inlet, South Carolina with my wife and our son and two new babies on the way in about 2 months. So a lot going on down here. Thanks for joining us today. We're going to start by kind of going over the different asset classes we have and the debt types for those asset classes. The largest asset class we have is multifamily. And debt on that has changed a lot in the last 6 days, 60 to 90 days or so. Obviously, interest rates are rising. We have a lot of lenders are kind of pulling back, being a little more cautious with who they give loans to, looking more into the experience piece of that, which is where we win a lot of deals. When they look at our experience and our track record, this is not our first time doing something. We have experienced partners. We have a sizable team of 40 or so employees backing that up. And we have a track record. So that really comes in handy. Most of our debt on multifamily in the past few years has been interest-only floating rate type debt. But given where rates are going, we're looking at a market in the future where we're looking more at fixed rate deals to kind of stabilize some cash flows and have some growth with rent growth that'll look good over time. Self-storage is another asset class we have a sizable holdings with. Those debt terms are a little bit smaller deals. Those are more with some larger banks, maybe some regional banks, depends on where the deals are. Some of those deals, if they're lease up storage facility, one we bought that is newly constructed is not quite, stable, fully stabilized. We can get a couple of years of interest only on those loans. Otherwise, they tend to be amortizing over 15 to 25 years or so. Pretty comparable rates, a little bit higher rates than multifamily, just given the asset class. A lot of lenders like self-storage, pretty stable, less ups and downs than multifamily. People tend to be stickier with storage investments. Once people put their stuff in a storage unit, it kind of stays there for a while. Whereas apartments, people bounce around in and out. Another asset class we have is car washes. We're currently in the contract for Car Wash Fund 3. Those are closing here in about a month or so. Anyways, those are more bank regional type debt. To focus, our primary focus is multifamily. That's our bread and butter. That's what we do. So we're going to kind of focus on that today. The current market has been tough, like I alluded to earlier. We work with debt brokers specifically on each acquisition. And a lot of times the debt brokers are brought to us by either the real estate broker, or if it's a deal we get off market, we have some relationships we go to help us find the best debt for those deals. Earlier this year and previously, we were getting 5 or 10 different bids from different lenders on those deals. And now that those number of people lending has kind of narrowed. On a current one, we got initially 5 bids, and we kind of narrowed it down to 2 finalists and picked 1. So it's a little bit smaller, but we're still able to make deals happen. And pretty good rates, I think, considering where interest rates have gone the last 3 or 4 months. So I say the next 6 months of the market are going to be kind of interesting. Depends on who you talk to, what expert you listen to. They're expecting rates to kind of slowly taper off and then stabilize and then hopefully drop at some point in the near future to a more stabilized rate, opposed to a quick increase. It's kind of by the feds meant to slow down inflation. So my job with passive is managing our lender relationships for new deals, as well as looking at refis, evaluating our portfolio, kind of seeing, is the loans we have on these deals at the current time the best deal, or do we need to look at refinance? On a lot of our multifamily properties, if we bought them as a lease-up deal, if they're not fully occupied, once they are occupied, we have created value there, and then we would go back to the lender, look for a refinance, or look for elsewhere for loans as the assets become more valuable. And with that, you get, with a less risky asset, a stabilized apartment property, you get better loan terms, be it higher loan to values, lower rates, etc. So more favorable terms there. We're going to take a minute and see if we have anybody on the call that has any questions. You can put them in the chat box, and I'll happy to answer them. Also, how many folks on this call were at Multifamily Investor Nation Summit a few weeks ago? There you go. We got somebody was there. Vlad was there. I think I recognize a few other names as well off the list. We can go more into the acquisition piece of what we're doing. Let's see. I believe we have one question here. From Jordan, the question is, what rates are you seeing right now for agency and bridge debt on multifamily properties? Good question. On our current offering in Charlotte, in Pineville, suburb of Charlotte, we got some agency bids that were lower loan to value. Agencies tend to be a lower interest rate, but they're also lower loan to value. Those were in the 50-ish percent range LTV. And those rates were the high fours, 4.7, 4.8, 4.9. But those come with, 7 or 10 years of prepayment penalties. So you're kind of locked into those for a longer term than we'd like to. We generally look for 5-year terms on our deals. It gives us flexibility if we do want to exit without paying hefty fees. On the bridge debt, we also we have some fixed rate options for that one. They're great deals, marginally higher than the government debt, but a much shorter prepays, higher loan to values, which are better deals. A lot of those loans are in the low 5s. Typically, the corresponding treasury rate, be it 5-year treasury, 7-year treasury, or 10-year treasury, plus a spread. And that spread is somewhere in the 2.75 to the 3% range. So that's kind of a gauge when we're looking at fixed rate. On the bridge debt, those are either LIBOR or SOFR plus a spread. SOFR, SOFR, is replacing LIBOR. Currently, it's there's 2 types of SOFRs. Let me back up. Term SOFR is the one most of our deals are based on. It's kind of forward-looking. That's about 1.93 as of this morning, 1.93%. And most lenders put a spread on top of that of 3 to 3.5 or so, sometimes 4, depending on the deal, the cash flow. So the bridge debt piece would be, if we had a deal today that we're doing bridge interest only on, you're probably in the 5.5 to 6% range. And then we, of course, will buy an interest rate cap to limit our upside down the road on that. And those interest rate caps are a whole other conversation. Those have gotten very pricey. Let's see here. We have another question from Sharda G. What is the best type of mortgage interest rate for holding multifamily? That's a broad question. Different multifamily owners have different business plans. If you're planning to buy and hold it for 20 years, you need to look at a fixed rate debt. If you're, on the 5-year horizon or so, I would look at some shorter term debt. You might be able to get a higher loan to value at a better rate if the deal cash flows. All this is based on experience, the deal cash flows, the strength of the guarantors or the partners. All of our multifamily deals are non-recourse, so there's no personal recourse, but they still look at the strength of the partners financially. A huge factor. So what is the best type of mortgage and interest rate? There's not one. I would look at your deal specifically and look at your business plan and then try to find the best structure for that. If you want to ask a follow-up, feel free to. Let's see. Morali asked a question here. What is spread and basis you are seeing in current market for bridge? Kind of already addressed that one. So the spread is 3.5 to 4% interest over SOFR, and SOFR right now is about 1.93, call it 2%, so 5.50 to 6% or so. But we are looking at more fixed rate deals just to limit our exposure on those. So let's see, we have another question from Jason. Are you finding lender costs are increasing as things are tightening? Currently working a refi and the fees, LTV, and rates are less desirable than typical. I'm assuming you mean origination fees. LTV and rates, those are kind of deal dependent. Rates are obviously market dependent. Those are going higher. There's no two ways about it. LTVs are kind of tightening. I think a lot of lenders are limiting or cutting off their investment into these deals, these loans. So the less supply is kind of driving the spread down there. As far as cost, lenders have origination fees. Some of them have like an underwriting fee, an application fee. There's different names for them. They're all the same thing. Most origination fees I look for, a lot of lenders start at 1%. I like to back that down. I look for 50 basis points or 0.5% to 65 basis points or 0.65%. I found a lot of lenders tend to be flexible with the origination fee as a function of the rate. So you don't want to beat somebody up on the rate, beat them up on the loan to value, and then beat them up on the origination fee as well. My advice would be pick one or two of those, and they have to feel like they're winning too. You got to feel like you're winning as well. Otherwise, they're not going to work with you if you sit there and squeeze them on everything. You got to be smart about it. So let's see here. Rogelio, I'm sorry if I mispronounced that, has a question. Historically, after the onset of a recession, the Fed lowers the interest rates. If we go into recession, do you see the Fed pulling back on the interest rates? I think you answered that question yourself. I hope so. I hope a recession is 3 consecutive quarters of negative GDP. So we're not there yet. I think we've had some ups and downs in economic reports. Hopefully we avoid that. But if we do go into a recession of some sorts, I hope the Fed would realize that quickly and reverse their interest rate increases quickly. So yes, I hope they do. Let's see here. We have another question from Andrea Yu. Your question is, has current interest rates prevented you from refinancing any of your existing properties? I would say no. Refinances are based on debt service coverage ratios or net operating incomes. So when a lender looks at a refinance, they want to see what's the net operating income of the property and then kind of back that into a mortgage at the current rates. So that's more net operating income driven. Obviously rates are a huge factor of that. But a lot of our deals are bridge. A lot of multifamily investors in the last several years have done bridge loans because that's the only thing that worked with cap rates being 3.5%, 4.5%. The higher leverage interest only bridge loans have been the only option for those. But when it comes time to refi, you got to think, are you going to have this for another year? Or are you going to have this for another 5 or 10 years? If you're going to have it for a longer period of time, I would look for some fixed rate debt. Or if you're doing an extension of the interest only period, I would look at capping your interest rate as tight as possible. Interest rate caps are expensive, but in the current market, a lot of them are paying off. It kind of limits your exposure to interest rates. Lenny asked a question here. Let me tag on to Andrea's question. How would you explain SOFR? Why is SOFR the gauge? SOFR is going to replace LIBOR. LIBOR historically has been the kind of the go-to rate for commercial properties, and it's going away. So SOFR is just look at it as like a LIBOR replacement. There's a couple websites you can keep tabs on SOFR. One website I go to keep tabs on that is called pensford.com. I'll type it in the chat box. On their homepage, they have the SOFR rate. Term SOFR is the one I'm referring to. There's also called a New York Fed or a 30-day SOFR. That's more of a backwards looking SOFR. Some lenders base their deals on that. So you need to clarify which type of SOFR you're getting if you are getting a loan based on that. And why is SOFR the gauge? That's kind of industry, kind of globally, has been the rate that's picked to replace LIBOR. Let's see. Michael has a question. Are there concerns that with tightening debt capital, that the deal won't be able to hit the returns? Yes and no. With proper underwriting, you look at the forward curve with where interest rates are going, and then kind of say, does this deal work with these rates? I think there's deals to be had in every market with every interest rates. So you have to be maybe more selective on your acquisitions. But we buy on floating rate deals, we buy interest rate caps for the term of the deal. So if we're buying a deal and it has a 2-year interest only or a 3-year interest only, we would buy a 2-year or a 3-year rate cap that would kind of limit SOFR at 2%, 2.5%, 3%. So even if SOFR goes to 4, 5, 6%, our rate is fixed for the remainder of the hold period. So that's big. Or like I said, like a fixed rate debt. We're looking at a 7-year deal right now with 7 years fixed rate. So it doesn't matter what rates do after we close that deal. So that might be something to look at. Underwriting a fixed rate debt deal may limit the deals that work with your underwriting, but I think it's smart if your hold period is going to be more than a few years. I don't think the rent growth we've seen the last couple of years, 15 to 20% a year, is sustainable long term. A lot of people's business plans the last couple of years has been buy a deal, adjust rents 15, 20% a year for the first couple of years, and then sell it. And while that might have worked in the past, I think a lot of investors are going to have to kind of change their mentality on deals and look at either longer hold periods, some value add deals, or finding other ways to increase values there. And make sure I answered all these. I believe I answered all the questions in the chat box. If anyone has any more questions, feel free to type them in there. Let's see. In the Q&A box, excuse me. Let's see. Here we go. Martin has a question. How are the interest rates affecting the IRR on new deals? With higher rates, you're going to be, so IRR is a metric of the whole deal and how does the returns look. With higher interest rates, obviously it tends to hold IRRs down, but either you find a deal that has better cash flow, you buy at a lower price, or you're a fixed rate deal that helps you hit your IRR targets I know on one of our deals right now, we put it under contract, a few months ago, and had to go back to the sellers and renegotiate a lower price because interest rates have changed so much. So either they take our deal or we walk away and find another one, right? We were successful in that because we have a great team and some very, very sharp folks here. So that helps your IRR hit your target as well. I think that's it's called a retrade or kind of repricing. If you're buying a deal and you get in a contract and rates change, that's a tool in your belt. Go back to the seller and say, hey, rates have changed a lot since we initially put this on a contract. We need to look at reducing the price to this to hit our targets, or we're going to walk away. I think a smart seller would entertain that option. As the buyer pool, I think is kind of getting slimmer on these deals. I know 6 months ago, a lot of our multifamily deals we were offering, there's 20 to 30 or 40 groups offering, then 5 or 10 would be in the best and final round, and then they take the top 2 or 3 and then try to bid those up a little more. Those rounds are slowing down. There's less people buying multifamily. So you need to be more selective with the ones you are buying, I think, is my advice on that. Let's see. Raviraj, sorry if I mispronounced that. There's a question. With Fed increasing rate by 3/4 of a point this month, and then another 2 or 3 increases, will you see major price reductions in 6 to 12 months on multifamily properties? Good question. I think we've already seen a little bit with the rates going up so quickly. We've seen, there's a property close to where I live. We didn't buy it. We looked at it. We look at probably 1,000 deals a year. But this particular property, they bought it last year for $56 million. They were trying to sell it this year for $86 million. They fixed it up a little bit, got a better tenant mix in there, some better rents, but did they create $30 million of value in 1 year? Probably not. But I think they were kind of riding that wave of cap rate reduction, prices going up so fast, seeing if they could find a sucker that was going to pay for it. I'd venture to guess that either didn't sell or it sold for a lot less than they're asking. We have seen some reductions on offerings recently because the rates went up so fast. I think naturally there will be either reduction prices or kind of stabilization of growth for the next kind of cap rate expansion. We've been in a market where cap rates go down. Lower cap rates mean higher prices. But I think we're in a market where cap rates are going to start to creep back up, which will drive prices down, especially with higher interest rates. So that's something to look at for the next 6 to 12 months. Let's see, Teresa, what's the difference between agency and bridge loans? Good question. Agency loans are government-backed loans with Fannie Mae, Freddie Mac, HUD, USDA, whatever it is. The government loans, there's pros and cons to those. A lot of those are, like I mentioned earlier, 7 or 10 year timeframes. You're kind of obligated. Well, the pros, you can get 30-year fixed rates or 10-year fixed rate based on 30-year amortization. HUD loans go 35 years, so they'll stretch your payments out. They also take 7 or 9 months to get a HUD loan. So when you're buying a deal, that won't work. You can look at that for refi. Another con to agency loans, they tend to be a lower loan to value, maybe 50% loan to value. So probably not the best fit for everybody. If you're looking at bridge loans, the inverse of that have higher loans to value. Historically, that's been 70, 75%. More recently, 60, 65%. At comparable to slightly higher rates than agency loans. So the question is, you want to put more money down and have a fixed rate for a long period of time, or do you want to put less money down and have either a floating rate or a shorter term fixed rate with a bridge loan? And bridge loans are banks, private lenders, insurance companies, life insurance companies. So there's a lot of options there. Paul has a question. Do you use a mortgage broker to get your 5 to 10 bids? or do you have to reach out to lenders individually? Mortgage brokers are a valuable resource. A lot of times they charge a fee as well. They have to make money, right? But I believe their value is created through the relationships with lenders, and they're helping us to be able to find the best deal. We have lenders. I can call 20 lenders tomorrow. But on a lot of our deals, the mortgage brokers are either the same company as the real estate broker. So the real estate broker gives us the deal, and then they say, hey, you should use our mortgage broker to help find the debt. And if you don't, they don't say this, but if you don't use them on a consistent basis, your kind of leads from that real estate broker might dry up. So it's kind of a non-spoken rule it's good business practice to use the mortgage brokers if that's who your real estate broker is. Same company there, like a CBRE or a Colliers or whoever it is. I think that's smart. Keith has a question. Has your team ever explored a bridge to HUD program to transition into a low long-term interest rate? I'm familiar with those loans. I get calls almost daily from people trying to give us those. The timing on those goes back to my answer earlier. They usually take about 7 or 9 months to do. And you need to have a longer horizon for a hold period for those to make sense. 5 to 10 years. We like to keep a lot of ours 5 years or so and not obligate ourselves longer in case we do decide to do a disposition prior to the 7-year term. Let's see, Chris has a question. What kind of rates are out there for undeveloped land for building in desirable areas? If it's a land only loan, that's going to be a bank or a private lender. You're going to get probably 50 to 60% loan to value. And that's obviously land has no cash flow. So you would need to personally have enough cash flow or through other businesses you have to carry that debt from an underwriting perspective. Or you could find a lender to do a construction loan where you can buy the land, do the construction, and then they would look at the cash flows of the deal once it's stabilized. On some of those loans, they'll give you proceeds to pay the interest the first 12 months, 24 months. That's called an interest carry. Some lenders will, at closing, put that money in an account and kind of pay for the loan itself if they think the deal is worth it. So we have another question from Scott. Are you still putting down non-refundable earnest deposits? On some deals, we do, like if it's a deal we know is going to work. Let me back up. A lot of our earnest money deposits are non-refundable, except for A, B, C, certain outs. You always want to have an out in a contract. We have a great legal team, a third party we use that helps us write these contracts that say, if the phase 1 comes back with some issues, if there's some other environmental issues, if there's things that weren't disclosed, there's all these different things in contracts where you would be able to get your earnest money back. Also, I like to do a longer due diligence period that gives you time to look at it and not have your earnest money be hard until after that. That's what we prefer. We do put larger earnest money deposits down on deals. So if a seller, think about it from a seller's perspective. If you're selling a $50 million apartment complex, you have two of the same offers, same offer. One person's putting down $2 million. One person's putting down $200,000. Which one's going to have more weight? I'm going to lean with the one that's putting down $2 million. Non-refundable, refundable. Obviously, I'm sure sellers prefer non-refundable, buyers prefer refundable. So depends on the deal. If this one we know is going to work, which we like to think they all will, we'll put down non-refundable. Lenny's question: when you try to retrade, are you willing to walk away from non-refundable deposits? Good question. you don't want, obviously you don't want to, but you have to go to the seller, and that is a risk. When you put down a non-refundable deposit, that is a possibility. Hopefully those deals you didn't put down $1 million, $2 million, you put down, you know, 5 or 10,000 if you have to walk away from it. So hopefully you're not walking away from too much. The flip side, in this market, like I mentioned earlier, buyer pools are drying up. So you're having less and less buyers. So I think a smart seller, if you go back to them, you know, with a reasonable explanation for reducing your purchase price, they should be open to hearing it. Some sellers, some people are just hard-headed, not open to that. And you may have to walk away from that. So I would try to keep my deposits refundable under certain circumstances. That, and also have your debt assumptions in your underwriting ironed out prior to making that offer. That's the best advice I could have. Have your underwriting. If you think you can get a rate of 5.5%, underwrite 6.5%. And if that gives you some room there in case things do go up, you don't want to underwrite, you know, 5.5% and the rates go up tomorrow. Then you have to go back to seller because you did a poor job of underwriting. I think some of that can be done through proper underwriting, kind of adding some more conservative measures in the underwriting. We have a few more questions in the chat box. Let's see here. You do deals in the NYC area. Passiveinvesting.com does not. We're geographically from multifamily, the Sun Belt, Texas, over to Florida, to North and South Carolina, Tennessee kind of area. We also buy car washes. Those are similar footprints. On the storage facilities, we're Colorado to North and South Carolina, and then Florida, Southeast as well. Kiki Williams says, how long prior to closing on a deal is the lender typically willing to lock in their proposed rate structure? Great question. I got one this morning and it had a 90-day lock, but it's not like a lock on your house. A lock, if you're buying a house, you lock your rate, that's it, right? It's locked for 30 days, 45 days, 60 days, it's black and white. On a lot of these deals, it's locked at X%, or assuming that the treasury rate plus the spread does not change by more than, let's say if your deal is 5.5%, it might be set at 5.5% or higher if the 7-year treasury rate plus 3% is higher, or whatever, however the math works out. So 60 to 90 days is a good term there, but keep your eye on treasury rates, because if you're, you know, the fixed rates are based on treasuries. So if your 5 or 7 or 10-year treasury rate goes way up, that could kind of negate a rate lock. So it's not, the rate locks are not as black and white as it sounds. Let's see. We have a question from Raphael. I don't know if you do answer this, but do you do new construction projects? On multifamily, we're not a developer. That's a different skill set. We have bought several deals that are not fully leased up. We've bought deals that are 10, 20, 30% occupied. I think there's some value created there. If you have a multifamily property that's 100% occupied, it's going to be worth a lot more than a property that's only 10, 20, 30% occupied. So we've bought some deals that are, it's called lease up stage. I think that's a good place to add some value, but you have to have confidence in the deal location. Know that you can hit those, you know, 95 to 98% occupancy rates that you hope to get to. Let's see here. We have another question. Michael, what other terms do you see and lenders require on new deals? More reserves, cash management up front, etc. A lot of lenders try to put cash management in their term sheets. That's one of the few things I try to take out. I don't like that. They want to see you have all your deposits go to their account every day, and they earn interest on that. I don't like that. We try to stay away from that one, or at least on a lease up deal, putting that off for a couple of years. More reserves. I would say, yeah, I think the reserve requirements have gone up a little bit. Different lenders have different amounts. Some lenders like to hold the reserves. Some lenders want to see that you have those funds at closing. Some will do X dollars per door per year reserve. Some do, $250,000 at all times must be in this account. If you use it, you have to refund it or fund it back up to $250,000. There's a lot of different structures on that. And a lot of times lenders have flexibility with that. So if they say you need to have $300,000 in reserves at all times, maybe you go back to them and say, hey, how about $200,000? Maybe they work with you on that a little bit. That's what I would suggest. We have a question. I can't even click on the name here. The initials are SG. It says, what is the minimum percentage down payment required for residential 2 to 4 unit, small commercial, and 5 to 10 unit? Residential 2 to 4 unit, that's more your traditional mortgage. I would just talk to a mortgage broker for that. I think a lot of those start at, my background in banking, a lot of those start at 20, 25% down. Unless you're living there. If you're living in one of them, let's say you buy a fourplex and you live in one, you can do less percentage down. That's where a lot of investors get started on multifamily. A lot of books will tell you that. Go buy a fourplex and live in there, but I don't want to live in a fourplex. I want to live in a house. The second part, small commercial, 5 to 10 units. I'd say 5 units up to whatever units, 3, 4, 500 units. You're probably 25 to 35% down for multifamily. A true multifamily is more than 5. Let's see. Andy has a shout out for his, I guess, financing. Let's see what else. Michael says, what IRR are you looking for now on value add multifamily? Has equity return expectations increased in this market environment? You say value add. We've been buying institutional properties, class kind of A+ properties the last couple of years. So the value add play on those is letting the rents grow organically due to market conditions. So it's not your traditional value add of like new countertops, new appliances, flooring, paint. We've kind of stayed away from those. That's not really fit our business plan right now. And has equity expectations increased in this market environment, equity return? I would say they've decreased I think a lot of investors know with rates going up and the cost of everything going up, you have inflation there. I think some of the returns are going to kind of stay the same or kind of tighten a little bit, but investors can't expect a 20 to 30% IRR over a 2 or 3 year deal. Inevitably, that's a great deal, and I hope I'll always hit that. But I think mid to high teens to low 20s IRR are good over a life of a deal. That doesn't mean that cash flow every day or every year, but over the term of a deal, I think that would be a good IRR to hit. We look for probably, I'd say, high teens IRRs, and a lot of times we exceed that prior to our 5-year business plan. That's when we may look at an exit, as if we've already exceeded our IRR returns 2 to 3 years early. Values have gone up exceptionally. Maybe a time to look at doing a sale. Let's see. A few more questions over in the Q&A. Lenny, is there an appropriate time in the process to call for retrade, like no less than 30 days from the contract date when you're supposed to execute? It needs to be during your due diligence process. If it's after your due diligence process, I mean, you've already lost your money at that point, your earnest money. So you do have some risk between, let's say if you do a 6-day contract, 30 days due diligence, 30 days to close. Hopefully you have an extension on that, but any request of the sellers to reprice should be done during DD. You can always try it afterwards, but the seller's not very motivated at that point. They just tell you no. Teresa, what were the reports that your lawyers inserted out clauses in? I'm not sure I follow your question. I would just make sure you have a good real estate attorney and tell them, hey, you want to always have some outs on a contract. That's just good business practice. I would talk to your attorney about that and look at each deal specifically. Chris says, at what rate right now would you consider a good rate on a value add class B 50 to 100 units to move forward on if DSCR is over 1 and cap is over 6? Hopefully the DSCR is way over 1. That's a broad question. I would look at, if that deal's in Alaska or that deal's in South Florida, 2 different questions. And are you looking at interest rates? Are you looking at cap rates? What kind of rate are you looking at there? So follow up on that one for me, Chris. Deep T says, do bank recourse loans have fixed and floating options? We were quoted a 1.5 spread over BSBY. Then why risk taking a bank recourse? On multifamily, a lot of bank loans are non-recourse. If you're given the same loan with recourse or non-recourse option, that's the easy one. But in my eyes, if you're gonna pay for it, what does it matter if it's recourse or not, right? Pay your debts. So I'm not familiar with BSBY. If you want to respond to that one there. I believe that's about it for our questions. If there's any more questions, go ahead and drop them in the Q&A box or the chat box or wherever, and I'll try to get to them. There's been some good questions, and I appreciate everybody's time today, and thanks for being on here. So I'll hang around for another minute or so, and then Bloomberg short-term bank yield index. There you go. Learn something today. I don't know. I'm not seeing anything tied to BSBY, so that's interesting. I'm not sure where you're located, if that's a regional thing or whatnot, but all our deals are either LIBOR, SOFR, or tied to a treasury of some sort, 5-year, 7 or 10-year treasury. Let's see here. Semi asked my contact. I'll put my email there in case anyone wants to email me. There you go. Ed@passiveinvesting.com. Let's see. We have one more question. Let's make this the last question from Alan. If you are a part owner of a multifamily, is it better to buy out your co-owners as a purchase or refi? Good question. If you want to, I'm assuming you want to be the 100% owner, own it yourself. If you have the cash to just buy them out, do that. If you think you've created some, it might be not a bad idea to buy them out and then do a refi to kind of get your money back. I have to think on that one a little more. You're welcome to email me if you have any more questions on that one or any of these. I'm happy to answer any questions you have. And well, I thank everybody for the time today. Thanks for jumping on here, and see you later.